Hello and welcome to the Fat Tailed Thoughts podcast. I'm your co-host, Stephen Dickens, and I'm joined by my dear friend, Jared. Welcome to the show, Jared.
Good morning, Stephen. How are you?
Yeah, I'm good. It's actually my birthday, so everything's good.
Happy birthday.
Thank you. I'm not going to tell the listeners how old I am.
Come on. You already told them on the previous one as we're going into millennials and Gen X.
I'm older than you. Let's leave it at that.
It's actually, Stephen, it's my birthday next Thursday.
Oh, okay. So,
but I think I'll still be younger than you.
You probably will be. You probably will be. That's the way this works, right? So, two huge topics for this week. We're part two of a two-part series where we're going into ETFs. So if you are at a sequence or this is the first time you've listened to the show, go back and listen to the previous weeks. That was a fantastic history lesson on ETFs and mutual funds and how we ended up where we are. We're going to kind of continue the story. But the big topic that I took away from the newsletter, which we'll put in the show notes for those who aren't realizing this is a podcast covering a newsletter yet. But one of the big topics that you talked about, Jared, and I want to go straight there first, was concentration.
Yeah.
We think there's a lot of these ETF products. We think they're very diversified. Certainly I did from our conversations leading up to this podcast. Talk through for the listeners, if you would, what you found out, and what we're seeing when it comes to concentration.
Will do. So, Stephen, we need to hit on, and we covered this last week. We'll kind of briefly cover it here. The mechanics of how an ETF actually works. And just for those who either didn't listen or maybe it's been a week since you listened, ETFs work by having two different markets. There's a primary market where authorized participants, basically big banks for the most part, are creating and redeeming ETF shares with the issuer. And then you and I, when we go and buy and sell ETFs, we're actually operating, Steve, in the secondary market where you and I are buying and selling already created ETF shares from one another. And that's going to be an important distinction as we talk about kind of two different types of concentration risk here. So the first part's going to be Apple and Microsoft. And I'm just going to hit with the headline here.
And this is scary for my own portfolio. I've got Apple and Microsoft for full disclosure to the listeners, and then a bunch of high growth and large cap ETFs.
Yeah, you may own a lot more of those than you think, Steve.
Yeah, so talk us through, and I can't imagine I'm alone in this.
Oh no.
So talk us through what, and there's some fantastic statistics in the newsletter. So I highly recommend you go sort of take a read of that. But talk us through this, Jared.
Cool. Yeah, so it's become a really interesting story, Stephen. So I think everyone who kind of generally follows the market has seen that in the last 5-10 years, the top couple companies in the market have just gotten bigger and bigger and bigger. You've got Amazon. I mean, remember what was it, probably 2 years ago now, the first $1 trillion company. And now it seems we got a whole basket of them. Well, two in that regard really stand out there, Microsoft and Apple. They are both not quite multi-trillion-dollar companies, but well on their way to $1.5 trillion plus dollar companies. I think $2 trillion plus now. The challenge is they're also growing incredibly rapidly. So they're growing revenue at 20-30% over a year. And if you actually get under the covers, for instance, with Microsoft's cloud business, it's growing much faster than that. What that means, Stephen, is that you end up finding these companies in two different places in the ETF world. If you're an indexed ETF that, say, wants to match the S&P 500, you end up owning Apple and Microsoft. We're going to get into percentages in a sec. If you are an ETF that says wants exposure to high growth technology companies, you own Apple and Microsoft. What ends up being funky about that latter one is if you're, say, a big ETF, Cathie Wood's ARK ETF has grown quite rapidly over time. One of the challenges you have is just a law of large numbers here. It becomes difficult to move significant dollars into the market. You can't go invest in a $20 million market cap company if you're a multi-billion dollar ETF. It just doesn't, the math doesn't work to move the needle. So you end up more concentrated in bigger companies that you can actually deploy real capital into. Well, that means you're going to be putting even more into Apple and Microsoft. You're going to start to look more and more like the indexed ETFs.
So why is that? So why is this a problem though? Those are fantastic companies. In my day job, I'm a tech analyst. We cover those companies for disclosure. Microsoft's a client of ours. They're fantastic companies doing very well, exposed to secular trends in the market that are exploding, cloud, 5G. So for both of those companies, they're the right companies in the right place. Why is that a bad thing? You talked about contagion in the newsletter. Just maybe sort of unpack that for a moment.
It's a really good word. So Stephen, and full disclosure, so I via indexes own both, and directly exposure to Apple, and actually indirect exposure via Berkshire Hathaway, which is Buffett buys back more Berkshire Hathaway. I seem to end up owning even more.
I'm further exposed. I've got a bunch of Berkshire Hathaway for this.
Wait, we have to put this on pause and go look at our portfolios and then come back to the rest of the podcast.
Nothing we're saying is investment advice, by the way,
God,
just so we don't get into trouble.
Please don't. I'll give you cocktail advice, but not investment.
Yeah.
So, Stephen, this is important because, and let's just the hard numbers here. The top 5 ETFs by size, they account for an over $200 billion position in Apple and Microsoft. Together, the two companies make up about 12% of the S&P 500 right now. What that means is that as long as things continue to go well, they're good companies, they're strong companies. That type of concentration risk should remain hypothetical in nature. But stuff can and does happen, Stephen. You can end up with accounting challenges. Heaven forbid that there turns out to be fraud in one of the companies. And to be clear, I'm not suggesting that that's happening. I want to be very, very clear. There's no insight here. It's when you look at what risk is, you account for all the events that in theory could happen, even if you don't know what may happen. Critically, Howard Marks here makes a really good point. If you go and read his letters, he says risk is not something that you can a priori before the event put a probability on. This is a really good example. If, let's say, there turned out to be a WorldCom or an Enron type problem in a company the size and scale of Apple or Microsoft, well, immediately the shareholders will get hit as folks uncover that it's a fraud and stock price crashes and lawsuits and so on. But really, for the first time, because we have 45% of the assets in the market passively invested, you're going to get this reverberation through the market as it hits the ETFs. It then hits the ETFs holders, which is a lot of mom and pop in their 401ks and the like. Likely what happens in a scenario like that is a throw the baby out with the bathwater. Stephen, to use the word you hit on, contagion. Often what we see in those types of events are things like folks go, well, what other big tech companies? Oh, Amazon. Oh, Facebook. You start to see this effect that even though it's likely completely unfounded, it's I'd rather get out of it, put myself into cash, sit on the sidelines and wait and see where things fall than I do want to stay in and kind of ride the roller coaster.
So that's really interesting. And I think this isn't investment advice. We're not casting aspersions on those two fantastically run companies that have been well run for decades. But I think you're highlighting the potential issue. Maybe if you take those two names out, I'd imagine there's a concentration on some of the others you talked about: Facebook, Amazon, Google. Those big cap tech companies are also huge constituent parts of those ETFs also.
So I sit on the board of a nonprofit and chair the finance committee. So among the work I do there, Stephen, is work with the third party portfolio manager, think about risk at the level of the nonprofit. Tesla's rapid rise earlier this year was a point of conversation because we needed to have the conversation of, as it's going up and up and up and up, the nonprofit's exposure to Tesla was much, just by virtue that the underlying index stuff holdings was much, much, much larger than we had originally anticipated. Where that got particularly interesting was the discussion around Bitcoin and so on. Part of this became cultural, which is, was the nonprofit okay having meaningful exposure to a company that in turn was had meaningful exposure to Bitcoin? Now, that wasn't a call on whether or not Bitcoin is good or bad. It was culturally, was it appropriate for the nonprofit to take that position? And
so you decided to go. You decided to go all in on MicroStrategy. Is that what you're telling me? But no, I mean, so this is a huge topic. We've got a lot of ground to cover. We've got two other major parts here, so I'm going to try and keep us moving. I think the takeaway there is contagion, risk, do the work, understand what your exposure is.
So I'd highlight here as we kind of transition to other risks. This is a really good example. If you look at the name of our podcast and the name of the letter, Fat-Tailed Thoughts. This is a fat-tailed risk. And what I mean by that is, Stephen, we normally think of the world as kind of being normally distributed. You got this most events happen kind of in this space, and you got this long tail of possibilities of stuff that could happen. Nicholas Taleb and others have done really good work, quote unquote, black swan events of, hey, the probabilities of these highly unlikely events are probably a little bit higher than you think they are. And in aggregate, that can make a huge difference. This is a really good example. This is a very low probability event that an Apple or a Microsoft ends up fraudulent and that drives contagion and whatnot, but it's not zero. Mm-hmm. We as humans tend to think of almost zero as zero. It's not, Stephen. Yeah. And understanding that those risks are embedded, and if you want to, figuring out, how do I hedge against that? How do I find alternatives? Well, the first step there is understanding what the risk is.
So as we move on, we talked about concentration within the ETFs. We talked about concentration around a couple of particular stocks within those ETFs. But there's a mechanics of ETF creation and how this market works that certainly I wasn't aware of until last week's discussion and the newsletter and the work you put into this week's newsletter. Talk to me a little bit about concentration of how these ETFs are created.
So this gets into a space that's quite interesting. And this is one where we're really only just starting to get really good data in the last couple of years. So again, under the covers, authorized participants are engaging with the ETF issuer to create and redeem these ETF shares. What we see is that the big ETFs, the spider for the S&P 500 and the like, tend to have a quote unquote a lot of authorized participants who are creating and redeeming, because there's a lot of volume, there's a lot to go around. And a lot in this case might mean 25 that are active, maybe 30, 35 that are listed as eligible authorized participants. And when I say active, Stephen, what I mean is in the last 12 months, they've created and redeemed. They've actually engaged in that business. The challenge is the ETF market isn't like, hey, we got some big and some medium and some small. No, what we actually have is the top couple are accounting for $2 trillion, the top five or so out of the $5.5 trillion. What that means, Stephen, is we have this enormously long tail of other ETFs that are relatively small. Many of them only have one or two authorized participants who actually engage. So
and let's be clear, those two or three that we're talking about, they're all fantastically run businesses that haven't been bailed out by the US government in the last 10 years, 10 plus years. I mean, they haven't had to go and get government money because they're on the point of going out of business back in 2008. Am I being flippant, or
Stephen, you nailed it. You nailed it. World class, never been bailed out. Yeah, about that. So the challenge here is the small.
So before you jump there, if you've not read the newsletter, who are we talking about? What are these two or three?
It's what I would call exactly who you would expect. So it's Bank of America, it's Goldman Sachs, it's J.P. Morgan, it's Morgan Stanley, a name that may not be as familiar in the U.S. ABN AMRO, again, massive, just European domicile. These are massive players. And Stephen, so what we're going to hit on kind of two different types of risk here. If you are in the smaller ETFs, you tend to have far fewer authorized participants, which if one of them decides to pack up its bag and not do business tomorrow, that's problematic. But even as you go up market to these ones, I said, hey, they've got 25. Yeah, but it turns out that close to 80% of it is being done by 7 or so firms.
Too big to fail? Question mark.
So this is really interesting. So of the top, so of the 80% of flows, all but 2 of the top players were bailed out in 2009. If you then want to go down a level deeper and you want to look at just say the top 4, they account for 60% of all redemption creation of ETFs. All of them were bailed out in 2009. This is something that the SEC actually recently looked into, put together a study, is you get into other asset classes. So remember, ETFs can hold securities, which can include things like debt products. As you get into that world, Stephen, this challenge actually gets even worse. You end up with even more concentration among even smaller number of players. Again, exactly who you would expect and folks who were bailed out in 2009. So this is again, I'm not suggesting anything will happen, but what you have here is you have an embedded risk into how ETFs work, the underlying mechanism that ensures that the price of the ETF relatively matches the underlying price of the securities, sits on the back of a series of firms who not all that long ago had a whole bunch of problems and in the middle of a crisis basically went, we're good. We need to slow. We're slowing down. We're not trading because we're in the process of running out of cash, or we're in the process of becoming insolvent, or because the regulator came in and told us both of those things, and therefore you're going to stop.
So this is going back to your risk. I think if you'd have asked anybody in financial markets, maybe in 2005, where the Lehman Brothers had a chance of going bump, you'd have polled 1,000 people on Wall Street. If you and I had gone down with a clipboard onto Wall Street and said, what are the odds of Lehman Brothers being bankrupt in the next 5 years? I think nobody on that street would have given us, oh yeah, there's a high probability that's going to happen. If we'd have asked them to rank the probability from 0 to 100, right. I think if we'd have seen a 1 to 2% chance, that would have been the most it would have been. But obviously they went bump in the crisis. I think what you're talking about is this contagion risk with 3 or 4 firms in the US exposed to other asset classes, exposed to other lines of business that could impact them. Maybe their ETF business is very well run, but these banks do other things.
But these ETF businesses, the authorized participant aspect of it sits on the trading desk. It sits on that infrastructure. They're putting real capital at risk. It can be from a problem elsewhere in the bank that says, hey, we don't have the capital, the balance sheet to go do what we need to in this market, and therefore we have to pull back. And Stephen, this is like, I mean, again, when you start to look at the concentration here, Bank of America alone is about 25% of this market. That's an extraordinary slice of it. If you start looking under the covers, Goldman Sachs, good example here, like Lehman Brothers going into 2009 was not actually a bank. I know we call them a bank. They were regulated at the state level. They weren't a federally regulated bank. What that meant is as Goldman got into trouble in 2008, 2009 during the crisis, they weren't eligible for a bailout the way JP Morgan and Citi and the federally chartered banks were. So the Fed in slightly more formal terms, said, you will go register as a federally chartered bank because we are going to bail you out. And they are now. So if you've seen Goldman Sachs's Marcus, the whole retail operation, the fact that they're taking deposits now, actually that entire program is effectively built on the back of the Fed telling them in 2009, you're going to now register with us and you're going to be eligible for bailout. But I highlight that because if we saw a breakdown in the market with the distribution you have today, you're going to start to find out quite quickly that major players, major authorized participants, have different varying levels of eligibility to go get saved if something happens. That, again, is just yet another level of risk that it's the type of thing, it's long-tailed. It's almost certainly not to happen, but it's not a zero probability. It's the type of risk you want to understand now, not when shit hits the fan.
So before we scare our listeners too much and we force them off into a voyage of discovery to maybe go read the newsletter. That's a good voyage of discovery that we'd recommend. I want to keep us on topic here. There's been lots of market coverage, lots of debate around the Bitcoin ETF, and I'm going to put sort of brackets around that and go ETF question mark, and we'll get to that in a moment. But Bitcoin ETF, huge topic, lots of heat and noise in the system. If you're on crypto Twitter, you can't fail to see this be a topic of discussion. I need to. I've got concentration in my Twitter followers for the people I follow around crypto, and this has certainly been a huge topic. No one of the guys in this space, good friend of ours, Gabor Gerbax, who's been leading the charge here, so kind of got a bit of inside track of what those guys are doing. But unpack it for the listeners here. Bitcoin ETF, is it an ETF? What is it? What's been launched? Really just sort of go deep.
So I before we dive in, I have to tip my hat to Gabor and to the broader industry who have been effectively bashing their head against a wall for close to a decade now, working to get something approved. And I'll jump to the a bit of the punchline here. ProShares about a month ago, and Van Eck, where Gabor is, I believe earlier this week, finally got a Bitcoin, we'll call it an almost Bitcoin ETF approved. It's trading. You can go invest in it. Again, not investment advice, but it's a decade-long effort that's finally we're starting to see the light. And that's awesome work. I mean, just incredible hustle and a lot of deep thought of how you actually structure these things. But when I say almost ETF, Stephen, we touched on this in the last letter. ETFs can effectively only hold securities. And that's because they're issued under the 40 Act. There are a lot of other regulations. And by the way, 40 Act was unsurprisingly created in 1940. There are a lot of other regulations that came in the decade prior, the Securities Act alike through 33, 34, et cetera, building up to then the 40 Act. The reason that's important, Stephen, is, again, the 40 Act regulates funds that hold securities. Bitcoin is not a security. There's a lot of other things also that aren't securities, currencies and other commodities and so on. What that means is that there's this broader space of exchange traded products that can hold those assets, but they're issued under other regulations. Those other regulations don't have all the investor protections in place that the 40 Act does. So you may have, and I think most of us probably have heard of the gold spider. Hey, I can own a gold ETF. Stephen, it's not an ETF. It's an exchange.
So what, are they just jumping on the bandwagon of ETFs, a cool word that people understand and are invested in? So I'll call nobody's heard of ETPs. Everybody's heard of ETFs. I'll just call it an ETF.
Stephen,
isn't that an advertising standards? I'm British. Advertising standards agency issue of you're calling something that it's not.
I mean, it is a bit of us like saying it's Fat Tailed Thought sponsored by Beyonce, and just
Yeah.
Sure. I mean,
Well, no, it's like calling this podcast the Pomp Podcast when it's not the Pomp
yes.
Podcast. I mean, it's not an ETF; it's an ETP. Why are they allowed to call it an ETF when it's not an ETF? Right?
Short answer is if you go read how the SEC discusses these in their official work, as they discuss it in the speeches, they're very clear on the difference between the two. But certainly that's something the industry has let slide. And as I highlight in the letter, if you go Google gold ETF, you'll get these things. Top 5 gold ETFs. Here, 37 ETFs you should invest in to get exposure to commodities. And to a T, none of them are ETFs. They're all exchange traded products. So I hit on that nuance, Stephen, because for the Bitcoin ETF, that's actually that's about 50% of the story we have to talk about here.
It's not an ETF. Let's just get that out of the way.
So the one that came out is the ones that keep getting not approved are not.
So let's explain this for the listeners. There's a spot ETF, which isn't an ETF,
Correct,
and a futures ETF, which is an ETF. So just bear with us, listeners. We'll explain. Just unpack that for us. What's been approved? What is it? What hasn't been approved? And what is that?
Yeah. So what was approved is an actual ETF, and we'll call that the almost Bitcoin ETF. And I say almost because that doesn't actually hold Bitcoin. It holds Bitcoin futures. Futures being a contract that we agree today on a future date and future price at which we'll either buy or sell.
And the key point that, and I've done some research just personally as I've got invested in that particular ETF, it doesn't track the spot price of Bitcoin that you'll see on Coinbase and Gemini. There is a difference between that, and structurally that's meant to, I suppose, not meant to be the case, but is the case.
So the best academic research I've seen says that the futures price is quote unquote predictive, leading the underlying spot price by about 15 to 20 seconds right now. But over time, yes, you can see divergence between the two. An important time when that happens, Stephen, as I said, we agree now to trade at a future date. Most futures contracts, including the listed Bitcoin futures contracts, expire quarterly. So you can imagine that as we get to the end of quarter and folks are required to actually execute that contract and say, okay, we agreed it's going to be 50 and now it's trading at 60 or it's trading at 40, money's got to change hands to settle up. You can get some real funkiness in what happens is those contracts roll over to the next quarter's contract. What that means is you have these spaces where you end up with kind of very significant divergence between the price of the futures and the price of the underlying Bitcoin. There's also a bunch of fees that happen then that eventually roll up to, well, first the futures owners, and then, well, the ETF is one of those futures owners, roll up to the owners of the futures ETF as well.
So we've currently got approved a Bitcoin ETF that's taking futures positions on the Bitcoin price. What hasn't been approved is a Bitcoin ETP being marketed as an ETF. Right. Explain why.
So that exchange traded product, the goal and the most recent one was rejected just a few days ago. The goal of that product is rather than to hold the futures, only hold the underlying Bitcoin. And by the way, there actually is one approved in Canada, just not in the US. The problem, or rather challenges, the SEC has brought up are twofold. One is this 40 Act conversation that we've discussed before. Gensler, who's the current head of the SEC, Securities Exchange Commission, the primary regulator for these products, Gensler came out in August and said, I look forward to seeing a Bitcoin thing that comes out issued under the 40 Act. And that actually is what set off this whole thing we're now seeing. In fact, the next day we saw the proposal for a Bitcoin futures ETF that you could approve. the ETP trying to hold spot by contract, Stephen, one would not be issued under that. Be issued under Securities Act of 34. That is strong protections, but different, and frankly not as strong as the 40 Act. There are things embedded in the 40 Act about disclosures, what you have to tell your investors, et cetera, that you don't inherit. The second piece, and this is going to be, frankly, the more challenging one, we have things like that. The gold ETF, for instance, ETP really is like what we're talking about with the Bitcoin spot. The bigger challenge for the Bitcoin arena is what the SEC calls surveillance agreements. So under the covers, if the ETP is going to hold Bitcoin, the SEC wants effectively guarantees, or rather an insurance policy, that there isn't fraud and shenanigans happening in the underlying Bitcoin markets themselves. And among the things they're concerned about is if you're a major player in that issue and creation, the creation redemption process for the ETF, and you have the ability to perpetuate fraud in the underlying spot market, in the underlying Bitcoin market, you could make money hand over fist by fleecing the ETF investors.
But so are we on and I've got to wrap us up pretty quickly here. Are we on a path? We've got an ETF that's got futures. We've got institutions like Square and MicroStrategy and Twitter and Tesla starting to put Bitcoin on their balance sheets as an investment, as an inflation hedge. Are we starting to get to a point where we're getting diversified enough? There's enough price discovery in the market. We're starting to get to a point where a spot ETP product would make sense, and the SEC could start to get comfortable.
Stephen, I would be shocked if we see it in 2022. I think we're at least 12 plus months out, and a couple things that go into that. One, that point on surveillance agreements, they're unlikely to back away from. I would highlight here that means that the SEC, who's saying you can invest in futures but not Bitcoin directly as an ETF, has a different opinion than the CFTC, another regulator, who's allowing the futures to hold the Bitcoin, to reference the Bitcoin directly. Different interpretation of that market. There's a bit of both regulatory arbitrage and turf wars going on there. So point one, the SEC has given no indication they're going to come around to the point of view that the underlying Bitcoin markets are good, or that we have the infrastructure to demonstrate that they're safe. The second thing is there's a bit of CYA here by the SEC, that the cover your ass approach, which is right now they're saying ETFs can hold things that are regulated by another regulator, by the CFTC. So if something were to go wrong, Stephen, in the Bitcoin markets, and that affected the futures, and that affected the futures ETF, well, the SEC can point the finger and say, well, we didn't say anything about the underlying market. We said the futures are fine, and we were relying on that regulator's guarantee that futures are okay.
And government departments and regulators never do something like that. They're never looking to point the finger at somebody else.
It is a balance here, Stephen, because, and I'll talk out of both sides of my mouth. The SEC, in one respect, is limiting risk, because they say there's effectively already a product out there that's taking on the risk of the underlying Bitcoin market. So we're going to limit the novel risk to a product built on top of the futures. We also have effectively two layers of regulator review on top of this thing, one at the futures, one at the ETF. That's probably going to make it more safe for investors than would otherwise. So in one sense, the SEC is being conservative. In the other sense, some of the things we talked about, the futures don't always track the price of Bitcoin. You can incur these rather ridiculous fees that are ridiculous, meaning unexpected to the ETF holder, as the futures contracts roll over quarter to quarter. You also tend to end up with much higher management fees for that futures ETF than you do for spot. There's a trade-off here, Stephen, which is, yes, in one sense, the SEC is trying to protect investors, but maybe all of the costs incurred from a futures ETF as opposed to a spot outweigh the hypothetical costs of what may happen if, let's say, there are fraud in the market. And the SEC is making a bet.
It's a wait and see, right?
Exactly.
It's a wait and see. So Jared, we set the objective when we started recording these of making them 30-minute shows. We're on a track to it now being an hour-long show. We're 35 minutes in, so I'm going to wrap us up. Fantastic discussion today. Lots to unpack. Emerging space with the Bitcoin spot ETF and obviously what's been approved. You've been listening to the Fat Tailed Thoughts podcast. My name's Stephen Dickens, your co-host. I've been joined this week, as always, by Jared Klee. If you've liked the discussion, please give us a 5-star rating. If you've got issues, Jared's Twitter ID is Kleebeard. Send all your issues that way. Please click and subscribe. Tell your friends about it. Get engaged with us on our Twitter profiles. But also make sure you read the newsletter because we go into more detail there every week. You've been listening to the show. We thank you for that, and we'll speak to you next week. Thanks very much.